Coffee first, and let's get started. We're in the middle of corporate earnings season for quarter number 3, and financial companies and banks traditionally being first to report. So today we will analyze their report and try to understand what's happening in the economy overall. Hello everyone, this is Alex, portfolio manager, currently working and living here in Portugal. Before we begin, as usually, small disclaimer: don't forget to like this video and subscribe to my channel. It helps me a lot to promote my videos. So today we will talk about Bank of America report, JPMorgan, Charles Schwab, Discovery Financial, and Taiwan Semiconductors. So buckle up, get comfortable, let me share my screen, and let's get started. Let's start by taking a quick look at how global indices are performing. I usually focus on two key metrics. It's 1 week performance and year-to-date performance. So what do we see here? Most indices are trading in red over the past week, and especially Europe, showing predominance of losses. However, if we look at year-to-date performance, things look pretty good, with global markets delivering solid returns across the board, regardless of the locations. It's Asian, European, and America's market. Moving on. One piece of news that caught my attention is escalating conflict between Qualcomm and ARM. Essentially, ARM Holdings has decided to terminate a license that Qualcomm has been using for years to develop their chips. They've given Qualcomm a 60-day notice. If this actually happens, it could be a major setback for Qualcomm, since they rely heavily on ARM's technology for most of their Android processors. Qualcomm isn't taking this lightly, calling ARM's move baseless. This whole situation started when acquiring Nvidia, I guess, where I saw this name. Okay, never mind. Acquiring of Nvidia, which ARM claims violate the license agreement. Let's quickly take a look at stocks charts to see both companies have reacted, because especially since this news just broke today. So Qualcomm, US equity, and GP line chat. So we see, as we can see, just 1 day performance, negative 2.31%. Not that bad. Let's take a look on ARM performance. So probably both companies show negative performance over the day. GP line chat. Okay, 1 day. So also negative 4.9%. That's pretty big negative results, over 5%. So that's very interesting. You can see how the market reaction over the news. So today let's let's dive into earnings report. As I mentioned earlier, we're right in the middle of earnings season, and traditionally the first to report are banks and financial and investment companies, which will be our primary focus for today's breakdown. So, Bank of America, we will see earnings analysis and sorry, not that comment. So let's dive into Bank of America's latest financial results. Despite a challenging economic environment, Bank of America's leadership under CEO Brian Mayen has managed to caution the bank against some major headwinds. While net interest income is moderating from its peak, there are signs that downturn could hit through late 2024, setting up for a stronger outlook going into 2025. One thing to note is Moneyan's focus on responsible growth, which has helped to mitigate risk like credit loss provisions. Bank of America keeping its expense growth under control despite inflation and has embraced digital transformation, giving its competitive edge over its peers. The bank's fee-based revenue, especially from trading and investment activities and wealth management, of course, have been a bright spot, contributing a strong Q3 result. Earnings per share hit 81 cents and it's 78 adjusted EPS, right? With impressive 12% return on tangible common equity. And even though through provisions for credit loss have seen slightly, the overall credit picture is improving with fewer losses in commercial real estate and cards. Let's take a look at model. Multiple periods and quarters to better see the results. Looking ahead, Bank of America is expecting modest loan growth and stable cost, with net interest income projected to reach $4.3 billion in quarter number 5, similar to third quarter's performance. Even as the bank forces regulatory pressures from upcoming Basel III endgame rules and potential rate cuts, its ability to maintain a balanced approach to revenue and cost efficiency remain a key to its success. So let's take a look on chart of Bank of America. It's provided financial results about a week ago. So let's take a look year-to-date performance and candle with moving averages. So that's pretty good performance during this year. It's $42 currently, and it's above all moving averages. Let's move on. Let's shift our focus on JPMorgan, where CEO Jamie Dimon's leadership continued to fuel long-term growth and profitability. JPMorgan's position as a market leader is clear thanks to strong investments and digital innovation, which keep it ahead of the competition. While economic risks have softened, the bank is seeing a robust performance in its card segment, driving loan growth and provisions. and its trading revenue hitting the historical highs. One interesting aspect is Diamond's appetite for acquisition. Smaller deals are opening up to new opportunities, especially in the UK, expanding JPMorgan's retail footprint beyond its US stronghold. However, there is still some speculation around CEO succession, but with a deep leadership bench and a strong corporate culture, the risks are pretty well managed. JPMorgan is also maintaining its leadership in debt issuance along with Bank of America and Citigroup, keeping fees flowing. Wealth and asset management, let's take a look. Multiple period. Here you can see how the report is structured. So wealth and asset management have been drivers with the bank seeing consistent inflows for over 20 years. That's which is pretty impressive. In terms of numbers, JPMorgan's report, let's take a look. Oh, sorry about that. Sorry, 1 second, guys. Financial analysis. Waters. So, JPMorgan reported EPS of $4.37, which is 4.40. Oh, sorry about that. Yes, which is 4.47 adjusted EPS with a return of tangible common equity at 19%, which is strong even by global standards. The bank is keeping cost under control, and despite $1 billion reserve build, changed offs were lower than expected. The bank's capital position is also solid, even as continued buybacks totaling $6 billion in the latest quarter. Looking forward, JPMorgan's net interest income is expected to remain strong, especially with ongoing card growth. Though loan growth in other areas may be slower, higher fee revenues is likely to balance things out. All in all, it's clear that JPMorgan's strategic investment, market leadership, and financial discipline keep it well positioned for long-term success. Let's take a look on analysis recommendations. Okay, nice. So actually, JPMorgan trading at 12 months target price, which is $230, and the last price it's very close to $123. That's very interesting. Let's take a look on the line chart. Yeah, very successful year, and also 5 years. 5 of most successful years. Nice. So, Charles Schwab. Next, let's talk about Charles Schwab when my terminal is works well. A company's that's navigating through some challenges, but has the size and asset gathering power to outcome them. One of the biggest pain point for Schwab has been cash sorting issues, which have kept profitability below the 50% target. However, as the Fed starts cutting rates, Schwab path to reposition its balance sheet and expand its net interest margin, aiming to 3% target by 2025. Schwab is also to see some leadership changes, with Rick Warster stepping in as the new CEO this year. While the strategy isn't expected to shift drastically, the focus remains on balance sheet management. Healthier markets could support trading and assets and wealth fees, even though secular fee compression is challenges across the industry. Interestingly, buybacks are still on pause as Schwab build up its capital in anticipation of stickier reputation requirements under Basel III. But on the bright side, the company's scale, especially after its acquisition of Ameritrade, continues to be a major competitive advantage, helping to offset these challenges. In terms of financials, Schwab saw a slight 5% increase in revenue in quarter number 3, so which is which is $4.84 billion. Through deposits dropped by $6 billion or 2% compared to the previous quarter. Still, core new assets grew by $95 billion, reflecting a 4% organic growth rate. The company's Tier 1 level ratio also improved slightly, giving it a more solid capital base. Looking ahead to 2025, Schwab's profitability could make a strong turnaround as rate cuts ease the pressure on cash sorting and support better net interest income. Stronger markets could also lift assets and wealth fee, driving Schwab's total revenue up by 14%. Although trading revenue might see a modest 4% gain, it's the growth in net interest income and fees that will likely push Schwab toward its longer term target. Here we go. Let's take a look on estimated graph. So the white line is Schwab's the last price, which is 71.61, and a blue line is EPS adjusted 2024. The red line is EPS adjusted for 2025. So which is dropping. So let's move on Discover Financial Services, and it's planned to sell to so Discover Financial Services planned to sell to Capital One, which is moving forward as the company works to address regulatory hurdles. Discover's leadership is focused on maintaining and conservative approach with efforts to resolve remaining compliance issues. The big news here is the pending merger and while the Department of Justice review still poses a risk. The deal looks on track for approval around year end. So, what makes the sale interesting is that it could boost Capital One's return on tangible common equity by about 1%, even before considering potential synergetic from combination the payments networks. But it's not just about closing the deal. And Discover has been managing its portfolio carefully with stable through elevated delinquencies and change-offs and reduction in loan balance after selling the part of its student loan book. Looking at financials, Discover recently tightening its guidance, which is, let's take a look on a model. Loan growth is slowing and the company has adjusted its net interest margin forecast to reflect lower promotional balances. On the upside, they've improved the charge-off outlook, expecting better performance in 2024. Expenses are also up, partly due to regulatory pressure, and Discover is pausing buybacks until the merger is complete to ensure the combined entirely is well capitalized. However, Discover is still facing some headwinds, especially with Consumer Financial Protection Bureau proposed $8 cap on late fees, which could significantly cut into revenue. But overall, Discover's profitability, highlighted by a return on equity of 17%, puts its strong position to navigate these challenges and finalize the deal. The sale of Progress Discover's ability to handle regulatory scrutiny and credit normalization will be key to securing approval, and if all goes well, the combination of Discover and Capital One could create a stronger competitor in the credit card market, benefiting consumer through lower cost and improved competition. Nice. Let's take a look at chart, line chart. Pretty good performance of the year. So let's move to non-financial report, which is Taiwan Semiconductor. As you know, guys, it's the biggest factory in the world which produce semiconductors, which can produce chips. It's a global leader in advanced chip manufacturing. TSMC is well positioned to see significant growth, particularly driven by the booming of demand for AI chips. The company's 2025 sales are expected to surge by 25%, with cutting-edge 3 nanometers and 5 nanometers nodes powering much of that growth. They advanced packaging technologies such as QoWoS are critical for producing of next-gen AI chips, keeping TSMC at the forefront of semiconductor industry. One of the standout points of Taiwan Semiconductor's outlook is impressive growth gross margin guidance, which is higher than 50%. Let's take a look. Model, multiple periods and quarters, which is 57% for quarter number 4, which is well above market expectations. This margin expectations is a direct result of pricing power, efficient production and continued ramp up of AI-related chip sales. In fact, TSMC's AI chips, especially for clients like Nvidia, are driving growth at accelerated pace. Despite a sluggish recovery in smartphone and PCs, TSMC focus on AI high performance computing, and their leadership in node technology should help them to maintain their dominance. However, there are some challenges on the horizon. Geopolitical risk and growing customer demand for production diversification outside Taiwan may pose especially as a US-led initiative aimed to shift some semiconductor supply chain away from Taiwan. Looking ahead, TSMC plans to double its packaging capacity by 2025. Through demand remains so high that even these increases might not be enough. They are also gearing up for a leap to 2 nanometers production by the second half of 2025, further cementing their leadership in the chip making space. On the financial side, TSMC capital spending is set to surplus $30 billion this year, showing strong confidence in their growth trajectory. And by 2025, they're expected to continue their upward trajectory with prices hikes and greater production efficiency, boosting both revenue and profit margins. That's something interesting here. Also, let's turn out our attention to how high the 10-year Treasury yields are trading at the moment, currently sitting above 4.2% mark. This is significant yield, and it's creating substantial pressure on the stock market, particularly the S&P 500, which likely remain under pressure as a result. So high bond yields tend to make equities less attractive, and this let's take a look. Yes, of course. And this could continue waiting on investor sentiments in the near term. So S&P 500 today negative 0.67%. If you need a financial or investment consultation, please visit my website, which is alexvoy.com. Fill out the consultation form right here, and my assistant will contact you to clarify further steps. As you can see, I provide consultations in various areas such as financial and retirement planning, education, opening and setting up of brokerage accounts in licensed and reliable investment firms, hedging, investment and trading. I do not provide consultation on taxes and active trading and speculations activities. So thank you. Also take a look on my X or Twitter account, and please subscribe. It helps me a lot to promote my videos and Twitter account. So thank you until then, and spend your money wise.